Okay, great. Thank you. It's good to be here. We were optimistic about the snow we were going to get, but it's still been a great time and a great conference as usual. So we're going to talk about delegated capital management, and I want to start by sort of channeling my inner Jonathan Berk and talk a little bit about what we already know if we look at sort of the mutual fund world, right? And I think Jonathan, together with Rick Green, had a great paper that really kind of helped us think through what's going on in the mutual fund world in terms of understanding, what should happen in a perfectly competitive market. We should see zero net alpha. Fund flows should be revealing information over time and play the role of prices. And that the standard contract, which is based on fees as a percentage of assets under management, is an optimal contract. And with the goal of this paper, what we want to do is sort of think about that same kind of framework in the background and understand what's different if we apply that framework to private equity. What changes? How does it affect optimal contracts? Does it look anything like what we see? So that's the goal of the paper. Okay. All right, so let me talk a little bit about just the differences between the mutual fund world and alternatives and what we need to capture. So in mutual funds, if you think about liquidity, it's continuous, right? You can buy, sell anytime, and they're trading underlying assets are generally very liquid. In alternatives, it's typically quite limited, right? You might be investing for a 5-10-year horizon, depending upon the type of strategy that you're investing in. The size of the fund is initially open. It fluctuates over time. In alternatives, it's often capped initially. There'll be a cap on the fund size and then fixed after that. When we think about fees, in the mutual fund world, we're looking at a percentage of assets under management. In alternatives, we also have a percentage of assets under management fee, but also carry as an additional fee. And we want to think through that. Contracts are generally symmetric in the mutual fund world, so all investors get the same terms, get the same contract. What we've learned recently, and in particular thanks to work my colleague Julianne and Emil's paper, is that we see a lot of tiering of contracts, that there tends to be some preferential treatment of certain investors in the alternative world. In terms of net alpha, we talked about zero net alpha for mutual funds. We tend to see consistent positive alphas coming out of alternatives, or at least that's there's that view. We'll understand better where that might come from in a moment. And then finally, information in mutual funds. We realize returns. We learn things about the manager's skill over time. Whereas with alternatives, we often think of there's an ex-ante due diligence process, some investors trying to understand who are the managers that might have the better skill and sort of benefiting from that. So these are some differences that we want to be thinking about as we think about this alternative space. And some of the puzzles is, why are the funds closed to investors? Why are managers turning away capital? Why are alphas positive and persistent? Why does the compensation contract look different in this setting? Why do we have this tiering? Why do different investors seem to pay different fees? And ultimately also, why is there even delegation? Why aren't investors who are identifying good managers, why aren't they just hiring them, bringing them in-house? And what is the benefit potentially of this delegated arrangement? So these are some things we want to think about. Now, let me just kind of review, because we're going to build on this model, sort of what's going on in Berk and Green, and then kind of see the changes that we want to think about. So again, just a reminder, what is sort of the background in Berk and Green, which is that skill is rare, but capital is not. Therefore, the manager should be the one ultimately capturing much or all of the rents. Skill is unknown. We're going to learn it over time from realized returns. Price is set to net asset value in mutual funds, so price can't equilibrate things. So what happens instead? Well, funds will flow, right? They'll flow in and out depending on whether the perceived alpha is positive or negative. And with decreasing returns, that means that size is going to adjust until the net alpha is zero, right? And therefore, the ultimate size of the fund, the assets under management, will reflect the manager's skill. And so charging a fee that's based on a percentage of assets under management is the optimal contract in this framework that gives the managers the rents based upon the skill that they are determined to have. By the way, one thing I'll mention that's interesting about that optimal contract is while the percentage, having a percentage fee is the optimal contract, the actual percentage that's used is indeterminate, right? We could have a higher fee with a smaller fund or a lower fee with a larger fund, and you'll get back to the same sort of result. The equilibration will still work within a range. So that's also interesting, something we'll come back to in our framework as well. Okay, so that's kind of the background of the Berk and Green framework. Let me also kind of fill in a little bit pieces of the model, because again, we want to build on this. So what's the structure here that we can think about? So again, think about excess returns that are being generated by the manager. There's some alpha, initially unknown. There's going to be some quantity of funds invested, and there's decreasing returns to scale. So beta captures that decreasing return to scale component that's going to reduce the returns that are generated, and then some idiosyncratic risk. And so the value added is going to be the quantity invested Q times the expected excess return, which will be based upon some current beliefs we have about the manager's skill. We'll denote that by alpha hat, adjusted for the decreasing returns based on that additional quantity, and then some operating costs of running the fund. So this is the value added that we've got in this framework. So this is a simple sort of quadratic optimization in Q. So what is the optimal scale going to be? It's just going to be the alpha hat over 2 beta, again, based upon the perception of the manager's skill at that time. And the expected excess return, therefore, will be alpha hat over 2, right? We're sort of optimally adjusting as, setting that quantity. Okay? And then finally, that value added, the expected value added, multiplying those two together is going to be alpha hat squared over 4 beta minus the operating costs. And of course, conditional on, we only want to do this if in fact this is positive. And so alpha m is just the threshold where alpha squared over 4 beta exceeds delta. Okay, so we'll call alpha m that sort of efficient threshold at which it makes sense to have the manager operate the fund. Now, what I want to point out here is, of course, this depends on this perceived skill of the manager, and that's a squared term, that's a convex term, so there's going to be value to sort of providing information, right? So if we can get more information, that's going to be valuable. In particular, if I could learn the true alpha at any point in time, what's the gain I would get? Well, it's going to be proportional to the remaining residual uncertainty, right? If I could reduce that uncertainty, that would be better, right? I could invest more efficiently. And so what happens over time, of course, in Berk and Green models, we're learning over time that residual uncertainty is decreasing. And but if we could have learned the information, we could have some improvement here. Now, what's going to change as we think about moving to alternatives where we have where we don't have liquid underlying assets? Imagine now we've got to set initially a scale of investment, and we're not going to get to change it for quite some time, right? So then we're going to have to keep it based on that initial information for some period before we can reset after we've learned additional information, then reset and so forth. And as I extend that illiquidity period and make it longer, right, the value of having ex-ante information is going to increase. Okay, so that's kind of the first key observation here, that with a longer illiquidity period, the value of information is going to be higher. Okay, and that's going to be the key motivator that we want to think about. So as we move from liquid assets to illiquid assets, that increasing illiquidity period also means increasing value for getting ex-ante information, if we can get it. Okay, so that's really the key insight that we want to explore. That's sort of the underlying discipline. Mutual funds, assets are liquid. We can kind of rely on this gradual learning over time. We don't lose so much from that. But with alternatives, the assets are illiquid. We've got to commit capital for extended periods. We can't reallocate it. It's going to be optimal to acquire information up front. But if some investors are doing that, and that's costly, right, there's going to be a free rider problem between the investors who are gathering this information and sort of certifying the manager's quality and those who aren't, and that's going to lead to some need for some tiering, some preferential terms in the optimal contract, as we'll see. Okay, so let's kind of put that all together in this framework and see where that leads us. And again, the case of liquid assets, we're thinking about Berk and Green. Here we're going to be illiquid assets and look at what that means and how we get this, what are the contracts that are going to lead to the right incentives for this ex ante investigation. Okay, so what's the contract, what's the framework going to look like? We're going to have a manager. The manager is going to propose a fee to an investor who might decide to become informed and say this will be the fee, FI, that you're going to pay. There's going to be some carry charge, so they're going to announce that up front. And in addition, a cap on the fund size, Q bar, which will be a function of the amount that the informed investor chooses to invest. Okay. Based on these terms, the investor is going to make a decision to become informed or not, pay the cost C to actually become informed, to learn alpha, and then choose the scale QI at which they want to invest. Okay. Given that informed investor's decision, the manager is going to raise additional capital from uninformed investors, setting a fee FU for these uninformed investors, and then raise additional capital potentially up to this cap that's been set initially by the contract. Okay, so that's the structure, the terms of the contract. Okay, so what I want to show first is I'm going to take a simplified setting and show you that with those ingredients alone, we can get to an optimal contract that will provide the right incentives. Okay, and I'm going to do this in a simple setting where we're going to suppose first that carry is charged linearly. I'll come back to what happens later when we recognize that carry is an option, right? But let's suppose it's just a linear sharing rule of the return after fees, okay? All right, so what's the optimal contract going to look like? In that case, the optimal contract is going to be linear. So we're going to say, given the informed investor's investment, there'll be some Q0 plus K times that investment. We think of K as sort of a co-investment factor. How much more funds the manager is allowed to raise per dollar of funds that the informed investor is contributing. So think of K as something bigger than 1, and that's allowing the manager to raise additional funds from uninformed investors. And how is this Q0 set and how is the fee set? Well, those are going to be determined as kind of based on that threshold I told you before. This Q0 in particular is going to be that what would be the optimal amount of capital for the fund if the manager is just at that efficient threshold, where we're just sort of breaking even. Okay? Note, by the way, what this means, and I'll come back to this later, is that this Q0, remember, this is already independent of the QI. This you can think of as coming from uninformed investors. Uninformed investors are going to supply that level of capital at a minimum. They may be supplying more as if QI is higher. And then the management fee for the informed investor is again based on that threshold, that minimum net return that we expect if we were at that minimal efficient size. Okay? And let me show you why this is optimal. So think about it first for the informed investor. What is their investment decision? Well, they're going to choose Q knowing that the manager's going to invest at the cap. I'll come back to prove that later, minus what their fee is, which is basically plugging these in. What they perceive is they're investing where the alpha is already offset by alpha M. Okay, so the amount they're going to choose to invest is going to be proportional to alpha minus alpha M over 2 beta, and then scaled by this factor Q. They're going to invest less if they know the manager is going to be raising a lot of extra capital in addition to what is getting from them. And if I plug in this QI into this cap function, what do I get? I get that then the total amount of capital is exactly going to be that alpha over 2 beta. In other words, we're getting back to the first best. These informed investors are only going to come in if alpha is bigger than alpha M, if we're in the region where it makes sense to proceed, and we'll have the efficient level of capital combined from informed and uninformed investors. Okay, what happens with the uninformed investors? Now once the informed investor makes their commitment, they can see how much the informed investor is putting in. They can see the cap. They can infer alpha from this, right? They can sort of free ride. And in fact, fund managers will advertise, look, we've got this big investment from this endowment, or et cetera, and they're an informed investor. So we can then set the fee for the uninformed so that their net alpha is indeed 0. And that's what we're going to do, set that to be 0. They know that, given the optimal amount of capital, the expected return is alpha over 2. That's exactly how we're going to set their fee. By the way, that's always above the fee for the informed, right? So we're going to get this preferential treatment for the informed relative to the uninformed investors. Does the investment cap bind? Are they going to raise capital up to that cap? Well, in fact, yes. Why is the manager always going to want to raise up to that cap? Why do we need the cap? Why does this cap bind? Because if we didn't have a cap, the manager would like to raise even more capital, would go beyond the efficient level. Okay, why would the manager go beyond the efficient level? Well, there's only a second order efficiency loss from raising additional capital beyond the efficient level, but we get to impose a first order loss on the informed investor because we're going to lower the net returns, and that informed investor isn't participating in the quantity coming in. So that negative externality means that the manager would always, without the cap, want to go past the efficient level of capital. So they're going to go right up to it. They're going to have to be stopped at it, but we're going to need a cap, even though for the uninformed investors at net alpha 0, we still need a cap at that point. Okay. Finally, what about how are S and K determined? We still have those parameters. Well, if we think about it now, we've got to step back and say the informed investor has to be willing to participate in this, right? And so we're going to at least have to cover their investigation costs. And so the S and the K are going to need to be set so that the expected per period rents that the informed investor ends up getting equal to the annuitized value of the upfront investigation cost. So just think of that as the per period annuitized value. So that's going to determine how the carry and that co-investment factor K are set. Now, what you'll notice, of course, is that's one equation. I have two remaining unknowns. So we're back to sort of 1 degree of freedom. This first best contract has that 1 degree of freedom like we saw with mutual funds. And so you can think of other economic factors that may be pinning down S or K. For example, the carry fee might be set as sort of a standard for the industry, and what we're varying is that co-investment factor, how much additional funds the manager is allowed to raise per dollar of informed capital. And so we can think of different ways of achieving that. Okay, so that's the, again, starting from that linear assumption on carry, very simple optimal contract, very straightforward to prove that we're going to get back to the first best, which means we can't do any better. There's no better contract, right? We're getting the first best. So we know this is an optimal contract. Now, the problem with it is that, it's not realistic, right? That linear carry would require unlimited liability on the part of the manager, because if returns were negative, right, then they'd have to pay the investor and make up sort of the difference. So that's going to be unrealistic. And so we want to think about is what's the optimal sort of limited liability contract. And here we're going to think about that carry as an option and see what changes, right? So now the net return is the return on the fund minus the management fee, and then you pay carry based upon whether that pre-carry, net of fee return exceeds some hurdle. So H is some hurdle rate, and then we get some fee based on that. So now the manager's only earning from carry, is never having to pay carry. Okay. So what changes when we do this? Well, one thing that changes is, now you think about it, if R minus F before, if we said there was a 0 net alpha, we could set, if we set F to be the expected R, we had 0 net alpha here, and investors broke even. Once you have carry as an option contract, then if this is 0, they're not breaking even because there's still some chance they're going to pay carry. And so, in fact, the sort of pre-carry return that you need to get to sort of 0 net of fee, ultimate net of fee payoff is going to have to be strictly positive, because there is some carry that's paid. There is the expected carry is always a non-negative number. Okay, so define R0 to be that threshold. It's going to depend on S and H, obviously, but there'll be some R0 for which that is sorry, this should have the epsilon in here from capital R, so there should be the uncertainty in here. That's a typo. Sorry, I had to leave that out. But we can define what that is, that sort of break even. And that's really going to be the main change to the contract. So what's going to happen is fees are going to get adjusted down by that R0. It's basically that expected carry cost that we know we're going to pay even at the break-even threshold. So we're going to adjust the fees down. The other thing that's going to change and sort of make this more complicated is now we're no longer going to have a linear cap. The cap is no longer going to be linear in the amount invested by the informed party. It's still going to have that same lower threshold, but it's going to be an increasing convex function. And the reason for this convexity is now, if you think about what's happening once we have option-based carry, the cost of carry, of the expected carry that the informed investor is going to be paying is becomes higher as alpha goes up. And so the benefit of higher alpha, the informed investor's net return is no longer linear in alpha as it was before. And that means the informed investor is not going to want to contribute as much capital when he learns alpha is higher. That's going to lead to a concave investment function by the informed. And to offset that, to get back to an efficient level of capital, we're going to have our cap to be convex in that underlying amount of informed capital. But everything will go through. We'll get back to sort of that first best outcome, just with a bit more complicated contract. We're still going to have that same one dimension of uncertainty, which is there'll be a scaling factor on the amount of capital that the informed invest, which is based upon a parameter we're going to choose in this cap function, just like we had before. That co-investment factor, there'll be something that acts like a co-investment factor here as well. And the only requirement is that we set the carry, the amount of carry and the hurdle rate together with K so that the informed party, from an ex-ante perspective, is earning that investigation cost and therefore satisfying their participation constraint up front. Okay, so that's what that contract is going to look like and is going to be optimal, and we think sort of has a lot of the key features that we see when we're looking at this setting. This is just as an example of kind of looking at how that's going to play out. So here we took some parameters where that minimum sort of efficient fund size is about $50 million. The informed investor is, again, going to investigate and decide how much to invest. Once they learn alpha, larger funds obviously are going to, high alpha funds are going to be larger with a greater informed share, right? When the informed investor learns that alpha is large, they're going to invest a lot. That's also going to allow the manager to invest more. But the proportion of funds that are represented by the informed investor will be higher in these high alpha larger funds when the news is good, when the information is good. Okay? And you can see the effect of changing that K parameter. It's going to rescale how much the informed gets to take of the pie. This is an illustration, again, as a function of fund size of what's happening to fees. The minimum fees is just equaling the delta, the operating cost of the fund. If the fund ends up being larger, the manager fee income is going to be higher. This is informed and fees from the informed. These are management fees from the uninformed. The difference between the manager fees and the total surplus is the expected profit of the, or surplus of the informed. And sort of you can think of the area between this dotted line and, and this orange line, the expectation of that is what is offsetting the informed investor's upfront investigation cost. Okay, let me talk about one last thing before we finish, which is, we talked about how we can get the first best through this contract. We have an informed investor, uninformed investors. But, at some level, if you back up, it's a little bit puzzling, right? The manager has the skill, the informed investor has the information. Why do we need these uninformed investors? What are they really doing here? They're just kind of free riding. Can we do without them? And the answer is, could we just, hire the manager in-house, for example? And the answer is actually no. That if we were to just try to do bilateral contracting between the manager and the informed investor, we're going to get an inefficient outcome. Okay? And the reason is because that once it's just the two of them, the optimal bilateral contract is going to distort investment in a way to try to prevent the informed investor from getting too many of the rents. Right? And we demonstrate this by combining some results from mechanism and security design, but let me just kind of tell you what that's going to look like in sort of a picture here. So if we, actually, let me go to this one first. If you look at what's the optimal bilateral contract, right, it's going to have the manager get a call option where the strike price on that call option is going to dependent on the amount that the informed investor invests. And what you can find if you look at sort of the surplus that's available, the dotted line here would be the efficient surplus as a function of alpha. What we're going to do in that bilateral contract is get the standard distortions when we're trying to prevent the informed party from getting too many information rents. In particular, we're going to store in the extensive margin and not run the fund if the reported alpha is too low. And we're going to distort down quantities if we do run the fund in order to reduce the information rents to the informed investor. These three lines just show for some different underlying parameters what that looks like, but in any case, we're going to get these efficiency losses. And so when you look at the sort of Pareto frontier that's achievable with the optimal bilateral contract, with investor payoff on this axis and the manager's payoff on this axis, it's well below, well, it's always below what we can get with the delegated contract with the uninformed investors. Okay, so we're going to be below that. And particularly if we're trying to hold down the rents to the investor and trying to get more rents for the manager that we can't even get sort of in this region over here. Okay? The only time when the bilateral contract really competes is if gathering that ex-ante information is so expensive that we got to give most of the rents to the informed investor. Then we sort of, then they're very close to each other. But otherwise, they're going to look very different. So finally, let me just kind of conclude with what's going on there. How does the uninformed capital solve this? So the way it solves it is as follows. If you think about what happens in this bilateral contract, the informed investor has an incentive to lie and report lower alpha in order to pay lower fees. They want to pay lower fees, and so they're going to tell, look, you're not as good as you think you are, right? We've got some bad news. And the way the bilateral contract sort of offsets this or makes this costly is by distorting investment down when the reported alpha is low. Why does uninformed capital solve this? Because it breaks the link between the informed investment and the total fund size. Now I can hold down the amount of capital I let the informed investor invest, but I can make up for that by bringing in these uninformed investors. And by doing that, we get around this problem, and it allows us to get back to the efficient solution. Okay, so just as an example, if you remember, right at the threshold where we're first able to launch the fund, the informed investor is essentially contributing zero capital at that point. It's all coming from uninformed, and that's how we keep down the rents that the informed investor can capture. So we're attracting the informed investor in, but we don't want him to get too many rents. The way we do that is by having the ability to raise capital as well from uninformed investors. Okay, so let me sum up, sort of key takeaways. Liquidity determines the optimal contracting structure. Illiquid assets need this upfront information gathering. That's going to be more important there. These two-tier contracts align incentives and extract rents. Uninformed capital plays a crucial role in getting this efficient outcome, and this delegation enables managers to capture the full rents from the skill that they ultimately bring to bear. All right, thank you very much.